In this episode, we begin exploring a part of modern auditing that can sound highly technical at first, but becomes very practical once you see what it is really trying to do. A student working toward the Certified Information Systems Auditor, CISA, credential will eventually notice that auditors are no longer limited to reading a few paper records, asking a few interviews, and drawing conclusions from a very small set of examples. Organizations now create huge amounts of data through business applications, access systems, payment platforms, change processes, and daily operations, which means auditors have new opportunities to examine patterns, test controls, and identify unusual activity in a more informed way. Audit data analytics sits right in the middle of that change. It is not about turning every auditor into a software engineer or a mathematician. It is about learning how data can help an auditor ask better questions, examine more evidence, and reach conclusions that are stronger, more timely, and more useful to the organization. Before we continue, a quick note. This audio course is a companion to our course companion books. The first book is about the exam and provides detailed information on how to pass it best. The second book is a Kindle-only ebook that contains 1,000 flashcards that can be used on your mobile device or Kindle. Check them both out at cyberauthor.me in the Bare Metal Study Guide series. A good starting point is to understand what audit data analytics actually means in plain language. In simple terms, it means using data from systems and business processes to support audit work through examination, comparison, testing, and interpretation. Instead of looking only at a few selected records by hand, the auditor can use data to review larger populations, identify exceptions, compare activity over time, and focus attention where risk appears highest. This matters because many important control questions leave traces in data, such as who received access, when a transaction was approved, whether a change happened outside the normal process, or whether duplicate activity may have occurred. Audit data analytics does not replace audit judgment, and that is an important point for beginners. The software may help reveal patterns or outliers, but the auditor still has to decide what those patterns mean, whether the data is reliable, and whether the results support a sound conclusion about control, risk, or process effectiveness. One reason this topic has become so important is that many organizations now operate at a scale where traditional manual review alone cannot provide enough coverage. A payroll process may involve thousands of transactions, an access management system may contain constant additions and removals, and a purchasing process may generate more activity in 1 month than an auditor could examine manually in a full engagement. In that kind of environment, relying only on small samples and interviews can leave too much unseen. Data analytics helps the auditor work more intelligently by showing where to concentrate testing, where control performance looks unusual, and where trends may suggest a deeper issue. It also helps with efficiency, though efficiency should never be the only goal. The bigger purpose is improved assurance. If an auditor can evaluate a broader population with disciplined use of data, then the engagement may produce a clearer picture of what is really happening instead of a narrower picture shaped mostly by convenience, limited time, or the luck of which records happen to be selected first. To use analytics well, an auditor first needs a basic understanding of what data is in an audit context. Data is not just a large table of numbers. It may include dates, usernames, approval identifiers, transaction values, vendor names, account types, status codes, timestamps, location details, and many other fields that describe activity in a system or process. Each field tells part of a story, and when fields are combined properly, they can help the auditor reconstruct what happened, who did it, when it occurred, and whether it followed expected rules. That means data analytics begins long before any chart or test result appears on a screen. It starts with understanding the business process well enough to know which records matter and which fields are likely to support the audit objective. A beginner should also remember that data can be messy. Records may be incomplete, inconsistent, duplicated, or extracted in a format that hides important meaning. Strong audit analytics, therefore, depends not only on using tools, but on knowing what the data represents and whether it is trustworthy enough to support further analysis. That brings us naturally to the idea of tools, because auditors need some way to organize, inspect, filter, compare, and test data once it has been gathered. In practice, audit data analytics tools exist on a spectrum. Some are simple and familiar, such as spreadsheet applications that allow sorting, filtering, formulas, and basic summaries. Others are more powerful platforms designed for handling larger datasets, linking tables, running repeated tests, or presenting results visually. Some organizations also use database tools, scripting environments, or specialized audit software that supports repeatable analysis across many engagements. For a beginner, the most important lesson is not the brand name of any product. It is the capability the tool provides and whether that capability fits the audit need. A simple tool may be enough for a small, well-structured dataset, while a more advanced environment may be necessary when the population is large, the relationships among records are complex, or the analysis must be repeated regularly in a controlled and documented way. Even though tools matter, techniques matter more, because the real value comes from the questions the auditor is trying to answer. One common technique is filtering, which helps narrow a large population to the records that meet a meaningful condition. An auditor might isolate transactions above a certain threshold, user accounts with elevated privileges, changes made outside standard hours, or approvals completed after the activity was already performed. Another technique is sorting, which can reveal patterns that remain invisible when records are viewed randomly. Dates placed in order may show unusual clustering, and values placed in order may show a small number of outliers with disproportionate importance. Grouping and summarizing are also useful because they allow the auditor to understand counts, totals, averages, and concentrations across categories. These actions may sound basic, but they are foundational. Very often, an important audit observation begins not with a complex model, but with a simple, well-chosen way of reorganizing the data so that the underlying story becomes visible. Another powerful technique involves comparing data from one source to data from another source so the auditor can see whether the records align as they should. If a human resources (HR) system shows employee terminations on certain dates, and an access management record shows the related accounts remained active for weeks afterward, that comparison may reveal a control weakness in account removal. If a purchasing system shows payments that do not match approved purchase information, the auditor may have identified a problem that deserves deeper review. This kind of comparison depends on common fields that connect the data, such as employee identifiers, invoice numbers, vendor codes, or transaction dates. The technique may sound straightforward, but it requires care because records from different systems often use different formats, different naming conventions, or different time rules. A beginner should understand that matching data is not only a technical action. It is an audit reasoning step that asks whether two parts of the organization tell the same story or whether a gap between them points to risk, error, or weak coordination. Data analytics also helps auditors test completeness and accuracy, which are vital concerns whenever a process depends on reliable records. If an approval workflow should create one record for every request received, analytics can help check whether expected items are missing. If transaction identifiers should follow a logical sequence, gap analysis may reveal missing entries that need explanation. If a control depends on dates being accurate, the auditor can test for impossible or suspicious combinations, such as approvals that appear to happen after implementation, access grants that remain active after termination, or records that contain future dates with no reasonable explanation. Accuracy can also be checked by recalculating totals, comparing field values against expected rules, or verifying that certain combinations of data make business sense. These techniques are useful because they help the auditor move beyond trust and into validation. Rather than assuming the system produced a reliable dataset, the auditor can test whether the data behaves in a way consistent with the process it is supposed to represent. A major strength of audit data analytics is its ability to identify exceptions and outliers, which often provide the most direct path to meaningful audit insight. An exception is an item that fails to meet an expected rule, such as a missing approval, an invalid date sequence, or a payment that falls outside established thresholds. An outlier is something that looks unusual when compared with the rest of the population, such as a very large transaction, an uncommon combination of permissions, or a burst of activity from one user account at an unexpected time. Not every exception or outlier turns into an audit finding, and beginners should understand that clearly. Sometimes there is a valid explanation, and sometimes the issue is less significant than it first appears. Still, These items matter because they direct the auditor toward areas where control may be weak, business process design may be inconsistent, or management oversight may need improvement. In many cases, audit analytics is most valuable not because it proves a conclusion instantly, but because it helps the auditor know where careful follow-up should begin. Trend analysis is another technique that becomes very useful when the auditor wants to understand whether a condition is stable, improving, or getting worse over time. Looking at 1 month of records may show that a process seems acceptable, but comparing 12 months may reveal that exception rates are rising, approval delays are growing, or privileged access requests have expanded much faster than management realized. This matters because risk often develops gradually rather than appearing as a single dramatic event. Trends can also help the auditor understand seasonality, business cycles, or the operational context around unusual activity. A spike in transaction volume may be normal during a year-end close, while the same spike in a quiet period might deserve closer review. For beginners, trend analysis is helpful because it teaches that auditing is not only about judging whether a control existed on one date. It is also about understanding behavior over time, since repeated small weaknesses may be more important than one isolated incident that appears serious but does not reflect the broader pattern of operations. Another common set of techniques involves finding duplicates, gaps, and sequences that do not behave as expected. Duplicate payments, duplicate vendors, duplicate user accounts, or repeated journal entries can all point toward control issues, process inefficiency, or in more serious cases, possible fraud. Gaps in numbering or missing records may indicate ordinary process design choices, but they may also suggest incomplete data, failed transactions, or activities that bypass normal procedures. Sequence testing can help the auditor determine whether events occurred in the correct order, which is often essential for understanding whether a control was preventive or only an after-the-fact correction. For example, if approval should happen before access is granted, the order of timestamps matters a great deal. These techniques are powerful because they allow the auditor to test logical relationships that are difficult to see by manually reading records one at a time. They also reinforce an important idea for new learners. Analytics is not always about advanced statistics. Often it is about disciplined testing of very practical business rules. Visualization tools also deserve attention because they help auditors and management understand patterns that might remain buried in raw tables. A well-designed chart, timeline, or dashboard can show concentrations of activity, unusual spikes, control exceptions by department, or the relationship between different categories of events in a way that is easier to absorb than pages of transaction detail. Visual tools are especially useful when the auditor needs to communicate results to people who may not work closely with data every day. Even so, visualization has to be handled carefully. A clear picture is valuable only if the underlying data is sound and the presentation is honest about what the data actually shows. A misleading chart can create false confidence just as easily as a confusing spreadsheet can hide a real problem. For that reason, the auditor should think of visualization as a support for analysis and communication, not as a substitute for deeper testing. The image helps tell the story, but the story still depends on evidence, context, and sound interpretation. A practical example helps tie these tools and techniques together. Imagine an audit of user access in a business application that handles customer billing. The auditor obtains a dataset containing user accounts, roles, approval dates, termination dates, and last login information. A spreadsheet or audit platform may first be used to filter for privileged roles, sort by inactive accounts, and summarize how many users fall into each role category. Next, the auditor may compare the user list against termination records from HR to identify accounts that remained active after employees left the organization. Further analysis may look for duplicate accounts assigned to the same individual, approvals that occurred after access was granted, or long periods of inactivity among highly privileged users. None of these tests by itself proves the full state of control, but together they give the auditor a far stronger basis for follow-up questions, sampling, and judgment than a manual review of a few randomly chosen records would have provided. While audit data analytics is powerful, it also has limitations that beginners should take seriously. The first limitation is data quality, because weak, incomplete, or misunderstood data can produce results that look precise while actually pointing the auditor in the wrong direction. Another limitation is context. A pattern that appears suspicious at first may have a valid business explanation that only becomes clear after discussion with process owners or after comparison with policy and system design. There is also the risk of false confidence, where the existence of a large dataset or a polished dashboard makes people assume the analysis must be strong even though the logic behind it was weak or poorly aligned to the audit objective. Privacy and access considerations matter too, since audit work often involves sensitive information that must be handled carefully and only for legitimate purposes. A mature auditor respects these limitations and treats analytics as one evidence source within a broader audit approach rather than as a magic method that automatically reveals truth without judgment. For a CISA learner, one of the most important mindset shifts is recognizing that audit data analytics is not mainly about software skill for its own sake. It is about learning to connect audit objectives, business processes, system data, and testing logic in a way that produces better assurance. The tool helps only when the auditor understands the process, defines the question clearly, chooses relevant data, applies a sensible technique, and interprets the result with professional skepticism. Someone who knows many software features but cannot connect them to audit risk may produce a lot of output without adding much value. By contrast, an auditor with strong process understanding and careful reasoning may use relatively simple tools to identify meaningful control issues that others missed. That is why introductory studies should focus on concepts first. Once the learner understands what the data represents and what the test is trying to show, the tool becomes easier to place in its proper role as a support for disciplined analysis rather than as the center of the audit itself. As we close, the most useful takeaway is that audit data analytics gives auditors a way to see more, test more intelligently, and communicate more clearly in data-rich environments. The tools may range from simple spreadsheets to advanced analytic platforms, but the heart of the topic lies in the techniques: filtering, sorting, matching, testing completeness and accuracy, identifying exceptions, studying trends, finding duplicates, checking sequences, and using visuals to support understanding. These methods do not replace interviews, observation, evidence review, or judgment. They strengthen them by helping the auditor examine broader populations and focus attention where risk appears most meaningful. For a beginner studying CISA, that is the right way to think about this subject. Audit data analytics is not a separate world from auditing. It is an extension of core audit thinking, using data as another powerful source of evidence to help answer whether controls, processes, and business activity are working as they should.
Thanks for listening. For more audio courses, daily newsletters, and more, please visit baremetalcyber.com.